After last week's policy pronouncement doubleheader from the Bank of Japan and the European Central Bank, it is the turn of the US Federal Reserve and the Bank of England this time around on Wednesday the 31st of January and Thursday the 1st of February respectively. Stock and bond markets are convinced that momentum is changing and that central banks are poised to pivot toward cutting interest rates and away from hiking them as inflation cools and economies suffer nothing worse than a soft landing. According to the ever-helpful website cbrates.com, there were 367 interest rate increases and just 17 cuts in 2022. But in 2023, there were 160 increases and 81 cuts, and there were more reductions in the second half, 56, than there were hikes, 46. And so far in 2024, all four policy moves have been lower. Now, let's be honest, these are the same markets that were pricing in a recession in 2022 and the first interest rate cuts from the ECB, Fed and Bank of England in 2023. None of that actually happened, so caution may be required. In all honesty, neither the Fed nor the Bank of England are expected to do anything at these meetings. Of far greater interest, therefore, will be any accompanying commentary, the Fed's so-called dot plot, which markets see as a clue to the future trajectory of American interest rates, and also how the voting split on the UK's Monetary Policy Committee, which was 6 votes for no change and 3 for a quarter-point increase last time around. To summarise, the US Federal Reserve is expected to keep the headline Fed funds rate unchanged at 5.25% and keep running its quantitative tightening or QT policy at $95 billion a month. Fed officials are starting to drop hints that QT and the shrinking of its bonds holdings could start to end soon, so we'll see. In the meantime, markets are still pricing in 6 rate cuts from the Fed, down to 4% by the end of this year, with the first cut coming in the next meeting in one of the meetings this spring in May, not March, according to data from the CME FedWatch service. The chances of a cut in March are now seen at barely 40%, down from 75% a month ago. The Bank of England, well, that's expected to leave its base rate unchanged at 5.25% and stick to its QT programme, whereby the central bank reduces its bond holdings on its balance sheet by £100 billion or 13% to £658 billion between November 23 and September 2024. Markets had started this year by pricing in 6 rate cuts down to 3.75% for the Bank of England, with the first move from Governor Andrew Bailey and his colleagues in March. That's been recalibrated to 5 cuts down to 4%, with the first move in May after stickier than expected inflation figures. On the corporate front, the quarterly reporting season in the USA is in full flow, and we will start to get the first fourth quarter and full year updates in the UK as well, along with a select number of trading updates from large, mid and small caps alike. Companies which may be worthy of further note include the following, although some of these dates could yet be subject to change. Pets at Home, S3 and Winstay on Tuesday the 30th of January, when WPP will also host an analyst meeting. GSK and ITM Power on the 31st, Shell, BT, 3i and Glencore on a heavyweight the 1st of February, and Airtel Africa and YouGov on Friday the 2nd. But the company which could just cause the biggest fuss in the week ahead is FTSE 100 member Diageo, the global drinks giant, best known for its Johnnie Walker and Talisker Scotch whiskies, Captain Morgan rum, Smirnoff vodka and Guinness, is due to report its first half results at the end of December on Tuesday the 30th of January. Now, 2023 was not one that the company will care to remember. A long-standing and highly respected chief executive, Ivan Menezes, announced his retirement, only to then pass away before the planned date. And one of the first jobs undertaken by his successor, Deborah Crew, was to dish out a profit warning back in November. That trading alert cited weakness in Latin America and a slowdown in momentum in Europe and Asia, notably China, in the second half of the calendar year of 2023 compared to the first. The only areas to show acceleration in terms of organic growth rates of sales were Africa and America. As a result of all of that, Diageo shares are down by a quarter over the past year, and they're no higher now than they were in 2018. It's almost as if COVID, lockdowns, interest rate cuts and furlough schemes had never happened. All of these raise questions about China, and especially Diageo's premiumization strategy, as it focuses on so-called super premium plus brands. All luxury goods firms seem to be facing a bit of a slowdown, and maybe they've pushed their prices too far, as consumers get less help from tax breaks and low interest rates and face tax hike and even higher borrowing costs. Now, analysts will look for comments from Diageo on cost inflation and how price increases and cost efficiencies can offset that. They'll also view the first half results relative to the company's medium-term goals out to 2025, which were reiterated by Deborah Carew alongside the autumn warning. And those medium-term goals are organic sales growth in the range of 5 to 7% a year, and organic operating profit growth in a range of 6 to 9% a year as margins rise. And when it comes to the interim results update, analysts and shareholders will look to 3 near-term indicators. Do note, however, that Diageo as of this year will now report in dollars, not pounds, but we're going to give all of these numbers in pounds for ease of comparability. The first number is organic sales growth, so you can check out particularly the underlying progress, excluding currency movements and acquisitions. In the fiscal year that ended in June 2023, total sales were up 11%, or organic sales were up 6.5%. Organic sales reflected a 0.8% drop in volume and a 7.3% increase in price. Analysts will look for details on volume and price this time around too, as well as on how premium price brands in particular are faring. Any comment on sales trends in the home or off-trade and out-of-home or on-trade will also be welcome. As a benchmark, analysts are looking for full-year sales to slip by 3% on a stated basis to £16.6 billion, while first-half sales a year ago were £9.4 billion. Consensus, according to the company website, is looking for a flat organic sales number in the first half of the year. The second number to watch will be profit. For the full year, analysts are expecting flat pre-tax profit of £4.7 billion on a stated basis, with operating profit also slightly down. For the first half only, consensus is looking for a 1.6 percentage point drop in organic operating margin and a 5% decrease in organic operating profit. That translates into an underlying earnings per share or EPS figure of 107 pence compared to 100.9p in the first half last year, helped by a lower share count in the wake of the ongoing share buyback. Finally, attention will switch to cash returns to shareholders. Diageo raised its dividend by 5% in the year to June 2023 to extend an annual growth streak that began in 1999. Analysts have penciled in a small increase to around 81 pence a share for the year to June 2024. That's up from 80p last year. That growth rate provides a benchmark for the first half, when Diageo paid 30.83 pence a share a year ago. Diageo is also running a share buyback program. In 2019, it announced it would return £4.5 billion to shareholders by this mechanism, and it did the lot by February 2023. It then added another £500 million scheme, completed that, and is now following up with another £800 million plan that it announced in June. I hope that you and your family are in good spirits and keeping well. Thank you for watching, and I look forward to seeing you again next week.